Good morning, Chris. It's the 1st September, and it only seems days ago since we were talking about July at the start of August. But here we are again. And for the most part, I think the takeaway I would say over August is it was quite disappointing from a stock market return. We seem to be making progress in June, July, and then August decided to wipe most of that away. What's your take on it?
Yeah, I think that's very true, Rob. It was disappointing in August from a weather perspective in the UK, I guess, no matter where you were in the area. But from a stock market or financial market perspective, you're correct. August generally showed slightly negative performances by global equity markets. The true would be the same in the bond market. Probably you did okay if you had your money in the bank or under the bed or something like that. But any sensible investor, of course, has to look medium term and think about the possibilities going forward. And the good news is that maybe, despite the fact that the Bank of England once again raised interest rates during very early August, I kind of feel, judging by lots of the insights that we've been getting over the last few weeks, is that the Bank of England and the other central banks of the world are starting to get so much closer now to stopping raising interest rates. And once you do that, then I'm wondering whether we're going to see some better thoughts towards the possibilities for global growth and related impacting financial markets in a positive way as we move towards Christmas and related.
Just on that point then, Chris, so we saw weaker markets in August. Was central banks raising interest rates the main catalyst for that weaker sort of period?
There are two things really. August is always generally a disappointing month because people go on holiday, they move away from the financial markets. Some people decide to sell out and bring the money back into the financial markets later on in the year. But you've also had a few special geopolitical issues going on, which inevitably always cause a bit of concern. You saw a lot of disappointing data from the Chinese economy, for example, over recent weeks, which has worried a few people. And of course, it doesn't matter if you've got the scope of lower interest rates in the world over the next 6 or 12 months. If China isn't growing, then maybe America won't be growing so much, etc., etc. So there's been that going on. You've also seen, I guess, some realization that despite the fact that inflationary fears are slowly moving away, that's maybe replaced by some concerns about, okay, do people have too much debt? Is even if interest rates might go down a little bit, doesn't the average person maybe have too much debt? House prices are still falling. That's no surprise to you or me. We've talked about this before, but that's also a concern, I guess, for the average investor or the average person who owns a house or is thinking maybe of buying a house. So you've got lots of other issues at work here. So August is one of those months where it's quite easy for the markets to fall back and be a bit cautious. More important is, as always with investment, you've got to look forward. You've got to say what's going to happen next. What's gone has gone. What is going to happen next? That's much more important. What I'm still optimistic about is that the world is still growing. And even though we've got lots of geopolitical concerns and worries about how whether we have too much debt or not, my optimism would still be that the world is still growing, companies are still finding okay things to do, inflationary pressures are starting to move away, and jobs are still just about still being created. You put all of that together, it's not an impossible backdrop. It's still a backdrop which I would regard as workable. And that's why I'm a glass half full sort of person. I'm always a little bit optimistic, but I still feel reasons for being optimistic. And I think for the general investor, you should still be thinking it's much better to put your money into a broader range of financial assets than it is to hide it under the bed or any other circumstances you might wish to put into work.
So looking forward then, Chris, if we park interest rates, because we're always talking about interest rates, and we know that if we can get them to peak and even, eventually at some point come down, that's going to help in a number of areas. Aside from that, what other opportunities are you seeing at the moment that are getting you excited going into the autumn?
Two things, really. The first is that we've come off a corporate earnings season. It's now a little bit old. We had it mostly in July and the first half of August, but that corporate earnings season was good. More companies are making progress than not, which is always a good backdrop to be in. So that tells you that the average company, big or small, are finding things to do. So that's telling you that if they're finding things to do, that's good news for the broader economy. And if the broader economy is okay, then the financial markets tend to be okay too. That would be my first observation. There is still a world out there which is getting bigger, a little bit richer, and that's good. The second aspect, I think, would be confidence, or if you like, a lack of confidence. And financial markets are funny things. They're a little bit psychological. And I know we talk about correctly the fundamentals all the time. We talk about interest rates and inflation and growth or no growth and everything else. But sometimes when people are a bit too cautious, and I observed that many people have pulled their money out of the financial markets in recent times, actually that can create an opportunity, because people are maybe not seeing some of the opportunities and positives out there. They're just a bit too focused on some of the negatives. And even though we can see cost of living problems and challenges, geopolitical matters and the like, there are also reasons why you can be feeling okay about the future prospects for the world. Some other observation would be we're entering September with markets being cautious, actually. And I think that is a little bit wrong. I would be a little bit more optimistic looking into the future. And consequently, it's still a good time to be an investor and to be finding, as per your own personal orientation and requirements, you should be allocated to the world's financial markets for your pension fund and other medium-term investment targets you're looking to achieve. So I'm liking the fact that the corporate earnings season told me that there was plenty of positives going on, but actually people have actually switched the other way and have become too cautious. And I think that is a bit incorrect.
On that point about outflows, we've certainly seen it from the data we're looking at from large investment funds in particular, have seen large outflows from their portfolios. I'm guessing some of that has been caused by the volatility and scaring investors, because it has been very choppy waters. Just on that point then, to give us the silver lining of volatility, as a former fund manager, how did you embrace volatility in stock markets? Did you take advantage of it? And clearly, did you get or can you get results from that volatility?
You can. I mean, this is actually the main source of many returns. It's funny, isn't it? I know you've shared before data that a large part of your full year or multi-year investment returns occur in times of difficulty or uncertainty, or days where actually nobody was optimistic, but there were reasons to be. There was a change which actually people realized was a positive and not a negative. That happened to me as an institutional investor a number of times, actually. And obviously, most recently, I guess many people will recall the financial market crisis, the global financial market crisis of 2007 to 2009, and how in early 2009, people were so pessimistic about the world. But actually, that was a fantastic opportunity to become an investor or to increase your investment. And that actually played off over the following 10 years. Which is often the way that investments can be. When you have a period of negativity, and even if it's a short-term period, the period following that can actually give you those returns which you're looking for. And across over a full year, and even more importantly, rather than us talking about an individual month or a quarter, again, we should look at a full year, a number of years together. If we think about financial markets last year, many investors struggled. 2021 was a good year, 2022 less good. 2023 is mixed. There are some goods and there are some less good aspects. But that tells me that actually when I look forward into 2024, that actually we're probably moving into a more opportunistic positive period. I'd be putting personally money to work. If I was managing institutional money today, I'd be saying any cash that I have or any available monies that I have to me, I'm putting to work at the moment, thinking about the positive payoffs over not just the rest of this year potentially, but into next year and beyond. I know we have some uncertainties next year still. We've talked already about elections in the States and the UK and other ones around the world, but there are some positives too occurring. The world is still spinning. It's still looking a workable backdrop in the sense that there are things which investors should still be excited about genuinely, despite all the things which hit the news or the front page of the newspapers on a regular basis. Quite often, when that fear factor is quite high, that's when you have your best opportunities as an investor. So if you don't want to worry about that, the key is, of course, just to be consistent. Just consistently start applying monies to your pension fund or your other savings product. And actually over time, over your lengthy period as an investor, you'll get those positive payoffs for it. So don't panic, don't worry, keep thinking, keep asking questions, but keep involved.
Brilliant. Thanks, Chris. Last question, and I know you haven't got a crystal ball, otherwise we'd all be on a nice exotic beach somewhere having cocktails. But as a fund manager going over the rest of this year, then what sector would you be most worried about, and what sector would you try and avoid, from an investment perspective?
Yes, yeah. So actually, it's funny. Year to date, the best performing investor in the world, investment sector in the world is technology. So some of those big technology companies that many of which you would have heard of, maybe are users of their products, other ones, companies such as NVIDIA, which do very clever things in very clever AI and related areas, some of which I barely understand myself, have done fabulously. Here's what I observe. Actually, probably going forward, they may be a bit duller. Because guess what? They probably made the majority of their gains this year, vast majority, perhaps almost too much. They had a bad year last year. They're having a great first 8 months of this year. But actually, I would be now taking some profits there, moving away into other areas which perhaps are less in favor at this moment in time. So, for example, when I look at pharmaceutical companies, by contrast, an area which normally when you have aging populations, people looking maybe for treatments that they can improve their longevity, life longevity and everything else, areas which are very important for the rest of the 2020s and into the 2030s, I see more opportunities there, to be honest, at this moment in time. From a purely sector perspective, of course, as always, you've got to look carefully at individual companies and everything else related to that. But what that really tells you, rather than some interesting chat about different sectors, is that the market is still opportunistic, but you have to be careful. Sometimes you have to accept that an area has done fabulously well and maybe it's going to struggle a bit to make any further progress here, whilst other areas really should have done better, but haven't for whatever reasons, but could play some catch up. And that is the way that financial market thinking is often. So I'm finding many sectors like that. And obviously below that, individual companies as well. It's the nature of the financial markets. I'm afraid research and hard work is critical to them. That's what makes them fun, but kind of busy and kind of tricky and sometimes as well. So there are things to be doing. It's not a simple backdrop out there, but it's not impossible.
Brilliant. Thanks, Chris. Thanks for the roundup. I know we've got our investment committee next week, so I'm sure we'll be chatting about other interesting things then. So until then, have a lovely weekend and we'll speak soon.